Okay, for those of you watching from home on the live stream today, Andy came in and asked about a position he had in Virgin Galactic. Now I like the stock, but I did not get in when it was around 15 to 17. So you're getting in a bit late now, and the implied vols are really high in here. So I was trying to show him an example of how to do a spread in here. What I did is I came in and bought a call. I bought a 25 call where there's a lot of volume. But unfortunately, I got taken advantage of by the market makers. They weren't showing a real market at the time, so I got taken advantage of. But I just did one contract, right? So that's why you stay small, because you never know whether these prices are real. And so they kind of got me. I bought it at 247. So now what I'm trying to do is I'm trying to sell the 30 for 147. That would get my cost basis down to $1, and then the most I could make would be $5. And that's between now and August 7th. So we'll see if the stock can rally back up in here. Obviously, I'm not going to get 147 unless the stock moves another $1 higher, which is unlikely. But we'll see what happens with the vols, and then we'll look to see. I'll probably do something here into the close, and the reason why I would do it into the close has nothing to do with the weekend. It has everything to do with the vols typically go up before the close, even on the weekends, because people who want to own protection are going to pay whatever it costs in the last couple minutes. Now, I don't have to get this. I don't have to sell this call, so I'm in a position where I may just wait if I don't get the price I want. I'm willing to risk the 247. I really want to sell that call for 147 and get my risk down to $100. So I'm staying small. I've only done one, and then we'll see where the market goes from here. But you're always trying to buy cheap and sell expensive. What I was trying to teach Andy with this is if you're going to buy an expensive option, you got to sell another one against it. So we just bought one for about 140%, and it's dropped a little bit more in there. And now we're going to sell one that's over 150%. But we have to be careful. We don't want to wait too long, because these vols do move around. And if they're really high and they start to drop, you'll lose a lot of premium. So for a beginning trader, you should just do it as a vertical spread. You should do them together. But for a bit more advanced traders who like to take a little more risk, what we like to do is we buy a call and we let it rally, and then we sell another one. So for example, if you look at what we did with AMD, we bought a call yesterday in AMD, and what we did today is when it rallied up, we sold another call against it. So we sold a 75 call for $1.80. So we've locked in an 80% return, and then if the stock goes sideways, we can collect an extra $180. All right, so we've reduced our cost basis to an 80% return, and we're looking at potential upside of 1,100% return. But we're guaranteed to make 80% return on our money, guaranteed. So that's what we're trying to do as a more advanced strategy, is use other strikes when vols are high to exploit volatility, time, and stock price relative to strike to lock in profits, but allow ourselves to continue to make high returns. So that's just an update from just now on the live stream. There you go.